The value of real estate is declining, major corporations are struggling, and the stock market appears to be in trouble. As a result, investors are selling their holdings, fearful that the long-awaited devastating recession has arrived. When it comes to financial markets, it's fair to say that the last 10 years have been relatively easy. Simultaneously, the S&P's 500 earnings have nearly doubled while its prices have tripled. The highest federal funds rate in history was in effect at the time. It amounted to only 2.5%. As a result, now is an excellent time for entrepreneurs and investors. Money has become more accessible, making it easier for businesses to increase their values in order to grow and for investors to profit. At the end of 2019, it appears that anything you buy quickly doubles in value. But, of course, the bubble burst, causing global chaos with businesses closing and financial markets collapsing. The long and bleak recession brought the financial world to its knees. That's correct. In reality, the world's central banks stepped in, printing trillions of dollars and distributing them to businesses and consumers, effectively kicking the can down the road. However, now that we've caught up to them and inflation is at 40-year highs, the game of printing money to save us is no longer viable. As we have seen, the Federal Reserve has been sharply raising interest rates, limiting the ability of citizens and businesses to obtain funds. To put it mildly, it has imposed a cost on the economy and caused havoc in the financial markets. Crypto has been destroyed. Finally, we are here. Despite everything that has happened so far and everything that will happen in the next year or two, this could be the best time to get ahead to build wealth. So let's talk about why this is such a great opportunity and how you can take advantage of it. Finally, we've arrived. Despite everything that has occurred thus far and everything that will occur in the next year or two, this could be the ideal time to get ahead and expand your fortune. So let's talk about why this is such a fantastic opportunity and how you can capitalize on it. It's a fascinating phenomenon and the main reason for the reversal. Most people, according to psychology, don't have specific investment goals. They have not made long-term investment time commitment. And as a result, when the news gets worse and the recession hits, they flee the prospect of short-term hardship rather than seizing this fantastic opportunity. This, however, is a terrible plan. There have been 15 recessions and 11 bear markets since 1926, for a total of 12 if the 2020 draw is included. As a result, the bear market lasted 14.7 years. Furthermore, the market has been in a bull market for 75.4 years. Think about it. These terrifying world-ending disasters happen only on rare occasions. And as you can see, if you have the fortitude to invest during these times, you will often be handsomely rewarded. Consider the following Great Depression outcomes. You earned 265% over 4.4 years. After the next bear market, he made 43% in 1.8 years, 210% in 4.1 years, and 908% in 14.8 years. And the trend continues. A good starting point is Tony Robbins' unshakable table. If you had put your money where your mouth was at the bottom of history's worst bear market, you would have made a 20 to 30 to 40 to 50% return just 12 months later. It was previously impossible to predict the market bottom. In reality, such gains are unlikely. It does, however, demonstrate the value of a bear market. For example, if you had invested at the peak of the market before the 2020 commodity slump, you would have received a return of around 9%. However, if you decided to invest a few weeks later at the market's low, you would be up roughly 60%. That is the significance of your entry point. And as previously stated by the youngster, these large drops are extremely rare. Bear markets lasted 14.7 years and bull markets lasted 75.4 years. These chances to put up with some discomfort in exchange for long-term gain are rare. During major opportunity recessions, it makes sense, but as investors, how can you take advantage of this opportunity without making costly mistakes? The first step is to keep up with market developments. As a result, you are aware of these possibilities when they rise. Step 2 is to execute your strategy, whether passive or active investing. Long-term investing, as we all know, is divided into two approaches. First, there's dollar cost averaging, also known as Warren Buffett's approach to long-term investing. And most people will follow the format. They will use dollar cost averaging. For those unfamiliar with dollar cost averaging, it is the process of spreading your money across the entire market using an index fund, such as SPY, which is a traditional S&P 500 index fund. And it is the world's most important index fund. Dollar cost averaging (DCA) is a common investment strategy that attempts to apply value investing principles. The term was coined by Benjamin Graham in his book, The Intelligent Investor. Dollar cost averaging, according to Graham, means simply that the practitioner invests the same amount of money in common stocks each month or quarter. In this way, he buys more shares when the market is low than when it is high, increasing his chances of achieving a desirable total price for all of his assets. In the UK, dollar cost averaging is known as pound cost averaging and, regardless of currency, unit cost averaging, incremental trading, or the cost average effect. It should not be confused with the constant dollar plan, which is a type of investment rebalancing. As a result, they choose a market tracking investment and invest the same amount in that investment at regular intervals from their investors. So, if you invest $2,000 every 6 months, your money is spread across the entire market through the index fund. As a result, the goal of this method is to remove any emotion from investment. However, it still provides the reward of the market's long-term performance, which is about 10% for the S&P 500 each year. You don't have to be concerned about your money or read annual reports. Of course, this method does not appear to be your time in the market, specifically capitalizing on the excellent opportunity of a stock market crash at first glance. In reality, you are, because $2,000 does not buy as many shares when the stock market is high. On October 9, 2007, you could buy 12.78 SPY shares for $2,000. A year later, however, the market crashed. This meant that $2,000 would allow you to buy 20.5 shares. It's fantastic. Naturally, when the price is low, you will buy more shares, and when the price is high, you will buy far fewer. You haven't had to make any adjustments to your investing strategy. As a result, we decided to use dollar cost averaging. That is how genuine passive investors take advantage of the opportunity. They've caused a major market crash simply by doing what they've always done. Many investors, however, prefer greater control over their portfolios and prefer a Warren Buffett-style approach to purchasing individual companies. They understand that having capable management teams give them a significant competitive advantage. And of course, they are on the safe side. In this video, we'll go over how active investors can avoid being taken advantage of when investing in this volatile economic environment. And the first thing we must consider is what is currently causing firms to suffer. And right now, the main issues are high inflation and raising interest rates, which means higher costs. Debt service is becoming more expensive and consumers are spending less. So how do you know if a company will survive? In such a climate, the business you're thinking about starting requires pricing power. Pricing power indicates that they have established a competitive position in which they can raise prices without losing sales. When consumers spend less on discretionary items, many businesses, for example, must cut costs. Firms like Coca-Cola, on the other hand, have significant rising prices. They increased beverage sales by 8% and concentrated sales by 4% in Q2. And during an inflationary period, this trait is critical to success. As Coca-Cola's costs rise, it may easily pass those costs on to the customers without repercussions. So that is the primary feature used to combat inflation. However, another critical factor to consider right now is the raising interest rate. The main effect of raising interest rates, of course, is that debt refinancing becomes more expensive. So the best way to ensure your company's survival during this period is to keep its debts to a minimum. Google, for example, has more cash than equity. Though the difference is only 0.05, they profit more than they pay in interest. Meta is even better because the firm's financials show that they have no debt, making them an excellent choice. Finally, my main concern is the company concept itself. Is this business model sustainable in turbulent economic times? Because consumers can't stop buying necessities, grocery stores, for example, again outperform during recessions. Customers and insurance companies will stop paying for home and auto insurance, and customers are simply tired of carrying cash. But as interest rates rise, they have less money to spend. I'm acquainted with travel agencies, and if the cost of living consumes more discretionary resources, holiday preparations may be abandoned. That concludes our discussion of why this is a once-in-a-lifetime opportunity in investing. See you next time.